Welcome to the Wall Street Lab podcast, where we interview top financial professionals and deconstruct their practices to give you an insider look into the world of finance.
Hello and welcome to episode number 29 of the Wall Street Lab podcast. And today we are talking private equity.
Yes, Leo had the pleasure to interview Dan Rasmussen. Dan holds degrees from Harvard University and Stanford Graduate School of Business. He has been working at Bridgewater Associates, Bain Capital, and is now partner at Verdad Advisors. He was also named one of Forbes 30 under 30 and is New York Times best-selling author of the book American Uprising, the Untold Story of America's Largest Slave Revolt.
It was great to speak to Dan. You will notice very quickly that he's a very smart guy and is not afraid to hold controversial opinions. And as you will notice as well, all his opinions are backed by a lot of data that he and his team at Verdad Advisors crunches together and tries to make sense of it. Most importantly, he tries to use public markets to capture private equity-like returns. And we talk about his background and what made him interested in private equity and how he goes about doing his research, the process that they go through to test ideas and implement them in their investment process at Verdad. We also talk about Japan, which is one of the markets that Verdad and Dan are excited about. So if you're interested in private equity and public equities as well, I think this is going to be a treat for you.
Awesome. Thanks, Leo. And before we jump into the episode, if you like what you hear, please leave us a 5-star review on Apple Podcasts or wherever you get your podcasts, which helps us out a lot. And now, without further ado, let's jump in.
Hello, Dan. Thank you very much for agreeing to speak to us here at the Wall Street Lab. This has been something that I've been looking forward to for quite some time, so thank you for taking the time.
Oh, it's my pleasure. Thanks for having me on.
Sure. So I guess for those who don't know who you are, we'd like to start by asking who you are and what your background is.
Sure. So I founded and run Verdad Advisors, which is a family of hedge funds. We invest in levered small value stocks. So obviously small value is well known, pioneered by Fama and French and dimensional fund advisors and others. Our unique angle on that is focusing on the subset of small value stocks that have debt on the balance sheet and are in the process of paying off that debt. And while this might sound fairly heretical to followers of Warren Buffett and others who love fortress balance sheets and cash on the balance sheet, et cetera, the inspiration for this is the dramatic outperformance of private equity over public equities from the 1980 to the mid-2000s, and private equity being levered small value, right? The key characteristics of what made private equity work over that period are small value, but with a 65% levered balance sheet. And that's essentially what we are imitating. There are no new ideas in finance. We're just copying good ideas from the past that worked. And in this case, it's private equity, which we see as a fusion of leverage and small value.
That's quite interesting, and we're going to get a lot into that later, but it would be interesting to hear how did you actually come to thinking about creating a company that would try to replicate PE-like returns in a different way? What is it in your background that qualified you to do that?
Yeah, so after college, I worked for Bain Capital Private Equity, which is one of the largest 10 private equity firms. And we did a massive study into what worked and didn't work in private equity and what had driven returns. And, we saw, very clearly that private equity dramatically outperformed public equity markets from 1980s till about 2006. And if you look at why that was the case, right? What distinguished private equity from public equities? Its size, value, and leverage. So the average private equity deal is about $200 million of market cap and 65% levered, whereas the average public equity is, $30 billion in market cap and 10% levered, right? So private equity deals are like really small and really levered. And then if you cut the deals by a valuation multiple, the cheapest 25% of deals, which are done at less than 7 times EBITDA, accounted for over 60% of private equity profits over the period from 1980 to 2011. And if you cut at 10 times EBITDA, which is roughly the median, above that, 50% of the dollars were deployed and only 10% of the profits. So private equity, you can think about what drove private equity returns as 3 factors: size, value, and leverage. The size and value factors we discussed, very well known in the literature. But what's interesting is that private equity was adding leverage to that very systematically and doing so in a very extreme form. And what led me to start this firm is that what I saw in private equity was that post-crisis, there was a massive inflow of capital into the private equity asset class that drove up purchase prices to, on average, about 11 or 12 times EBITDA today. And that's on pro forma adjusted EBITDA. So actual EBITDA multiples are probably the 13 to 14 times EBITDA, which is way above the 10 times EBITDA that I thought didn't work. And so I said, well, gee, I don't think that buying levering up companies that you pay 10, 11, 12, 13, 14 times EBITDA for is a good strategy. In fact, I think it's a really bad strategy. All the evidence I've looked at suggests that putting 6, 7, 8 turns of net debt to EBITDA on a business is a really bad idea. So I don't want to do that. I don't believe in that. What I want to go do is do what private equity used to do in the early 80s and 90s, which was buy companies that were really actually small value stocks. They traded 6 or 7 times EBITDA, 50, 60% levered. And it turns out there are, 2 places you can buy those, right? One, you can buy them in sort of the micro cap search fund end of the private equity market where things are still not that efficient. Or 2, you can buy them in public equity markets. And I like the public equity markets because at any given time, there are 500 or 600 of these for sale. And you can apply a bunch of analysis to figuring out, which are the best 40 or 50 to buy. Whereas if you're in sort of that inefficient small search fund type world, you're going to spend all your time, you're going to spend years finding each of these opportunities, much less, being able to choose 500 at once. And since I prefer sort of the intellectual aspect of the job, I said, I'm going to start a public equity fund to focus on this very, very unique niche within the public equity markets.
Interesting. So what we have been talking about over the last years, that private equity benefits from the liquidity premium, and that's responsible for part of the returns, as well as the operational improvements that they're able to perform in these companies. Those are not, in your research, you didn't find that there were drivers of return as well.
No. So I think that the idea of an illiquidity premium, right, to earn an illiquidity premium, you have to be able to buy illiquid assets at a discount, right? So someone has to say, like, hey, gee, this is really hard to transact. And so if you're willing to take it off my hands, I'll sell it to you for a discount to what a liquid, version of this would trade at. And that was true for a long period of time, right? Private equity is buying small, private companies at a 30, 40% discount to public markets. And so they were able to earn a premium return because they were buying at a discount. But it's not a sort of universal truth that illiquid assets trade at lower valuations than liquid assets. And what you've seen really accelerating since 2006 is now small companies are much more valuable in private markets than in public markets. And companies with leverage on the balance sheet are much more valuable in private markets than public markets. And so what you actually see is people paying an illiquidity premium to purchase things, expecting then to still earn an illiquidity premium from owning them. And my view is that you can't pay an illiquidity premium and earn an illiquidity premium in your return. You have to pay a discount to get a premium, and that's no longer the case. So I think illiquidity for many years was correlated with valuation discounts, and it's not anymore. And I think that sort of tricked people, lulled them into complacency. And then I think the other thing is operational improvements. Obviously, I think private equity firms talk a lot about this because they buy whole companies, right? That's one of the things that distinguishes them from public equity investors, right, who own minority stakes, right? The private equity guys, they own the whole company, right? So in theory, they can control the business. So what I did to test this is I looked at every private equity deal over the past 20 years that had issued public debt as part of its financing. And so that meant that you could see the pre-acquisition and post-acquisition financials. And so I figured, we can use this data set, and if there's huge differences pre and post-acquisition, we'll be able to identify that, there's the systematic operational improvement that private equity firms are driving that's driving this excess return. But we didn't see that, actually. Revenue growth slowed, margins were flat. The only thing that changes systematically is the massive increase in debt. Right. I think I come to a different conclusion that private equity firms don't want control because private equity guys are genius operators, right? Private equity guys are investors, just like the guys at the mutual funds, right? They're not like, look at who they hire. It's all ex-investment bankers. They're not hiring, former CEOs, right? And what they're trying to do is buy the company and then change the capital structure. And that's what you see in the evidence, right? So I know it sounds really good to say, we're genius wizards who add value through operational improvements, but how could that possibly explain the returns of an entire asset class? Right? And if it did, right, there was some secret private equity playbook. Surely Harvard Business School or Stanford Business School would bring would steal the playbook and teach it to their students if it was so brilliant. But I think the reality is there's no secret sauce to magically running businesses better that private equity guys know and that people not in private equity don't know. But what there is true is the systematic difference between companies where you lever them up a lot and ones that you don't. And that's what you see in the data.
So what we've been talking about until now has been leverage buyouts, right? Or are you talking about growth as well, or venture capital?
I'm even more bearish on venture capital, but that's a separate topic, yeah.
Yeah. Maybe we can get into that later. And just to confirm, the data that you looked at for these past leverage buyout transactions, were they U.S. based or were they global?
Global, but the vast majority happened in the U.S.
Okay. Have you been able to test whether the same conclusion is valid if you look at, let's say, European leverage buyouts or Asia leverage buyouts?
I don't have the biggest data set to be able to look at that, but I would say in public equities, which I know very well and have looked at in Asia and also in Europe, you find the very same thing, which is that size and value and leverage interact in the same ways. So I'd say based on the public equity research, I'd say it's the same.
Okay, good. So that's what brought you to Verdad. So what is it that you do today at Verdad to be able to pick out of those? You mentioned hundreds of companies that you could choose from. How do you pick the best?
So there's sort of a red team and a blue team, if you will. So you want to buy. I'd say the returns driver in value investing is going to be generally multiple expansion, right? So you want to buy companies that are. And also yield, so shareholder yield. So you're going to get paid by buying things at a very low multiple that then go up in value, and you're going to get paid by buying things with a very high dividend yield or buyback yield that thus return capital to you. And so those are the two mechanisms generally through which value investors are making money, because for the most part, value investors are buying companies with below average future growth prospects. So as a result of that, the variables that really matter are, buying the cheapest things, right? Because the lower the multiple, the more opportunity for multiple expansion, and buying things with the highest shareholder yield. And in the case of levered companies, both of those things are sort of magnified, right? Because leverage, if you have a levered capital structure, right, a small change in valuation is going to result in a big change in the equity value. And the leverage is also going to jack up your free cash flow yield. And so, leverage should, sort of amplify both of those effects. So if you think about those as sort of the drivers of return as your red team, which are basically, buy the cheaper things with higher free cash flow yield and more leverage, then you want to say, okay, that's going to show me a list of things that are, say, trading at 3 times EBITDA, 90% levered, and generating an 80% free cash flow yield. And you'll put your sort of intelligent, thoughtful analyst hat on and say, well, gee, a disproportionate set of the things that trade at 3 times EBITDA and are 90% levered, 100% free cash flow yield, look like they're about to go bankrupt, which is why they're trading at those valuations. And that's true, too. So your blue team has to be quality, right? So you've got to say, okay, I want to buy the cheapest of those things that aren't just cheap on a historical basis and about to go bankrupt, but that are not going to go bankrupt, that are actually going to mean revert, where we're actually going to see that multiple expansion, we're going to actually get that shareholder yield paid out to us because the company is not about to go bankrupt and its financials are not about to fall off a cliff. And so that's sort of the other half of the analysis. And so you want to essentially balance those two things. And a good sort of quantitative ranking system is going to incorporate both, balancing your need for jacking up returns with the reality that those higher return characteristics are often correlated with higher risk characteristics that relate to bankruptcy. So it's a ranking system has to balance those two, and that's how we think about what we do.
So how do you make sure you're not picking those that are not about to go bankrupt? How do you control for risk?
Sure. So there are a number of ways. Actually, credit ratings agencies are actually relatively good at this. So it's not like we're forging a new territory here. And intellectually, I'd say your biggest drivers are predictors of bankruptcy or debt to assets ratio, right? So if you've got or debt to operating free cash flow ratio. So if you've got really high leverage relative to your ability to generate cash or the assets in your balance sheet, you're at a much higher risk of bankruptcy. And then second, which is, asking a simple question is like, hey, have you been increasing your debt or have you been paying it down? Firms that have been paying down their debt are much less likely to go bankrupt than ones that have been borrowing to fund their operations. So, and if you pair those two together and you say, hey, avoid the companies that keep borrowing more and more, and the debt is already out of control on a debt to cash flow or debt to assets basis, and prefer the ones where they've been consistently paying down debt and where the debt is actually reasonable relative to their cash flow or assets, that's a pretty simple sorting mechanism. I'd say there are other related or sort of less obvious predictors of bankruptcy or really bad financial outcomes, one of which would be very severe negative momentum. So, hey, if the stock is down 80% in the last year, probably a reason to be careful. Second, if the stock is one of the most highly shorted stocks in the world, probably a reason to be careful. So you want to use those sort of technical or smart money signals to say, all things being equal, I'd rather avoid the things that the really smart short sellers are shorting, and I'd rather avoid the things that everyone else is selling and willing to sort of dump at fire sale prices to get off their books. And if you layer in, both those sort of technical signals and the more credit rating type signals, you're going to dramatically improve the returns of buying deep value stocks.
So is this a purely rules-based approach, or do you also come in and say, hey, the signals are saying A, but I actually think B is going to happen, or is it purely based on those metrics that you've quantified?
We believe in starting with a rules-based or ranking system. So our goal is to look at all the historical data, sort of like a computer that plays chess, right? You want to say, hey, what does the computer think about what I should do with my next move? And then I think secondarily, however, at the end of the day, these are companies that are run by people. There's news, and there's a lot that a computer doesn't understand. And actually the computers are best with sort of very big, simple variables, right? They're best at balancing, say, hey, how do I, think about something with a 30% free cash flow yield, but a 110% debt to assets ratio? Is that a good thing or a bad thing? And a computer is pretty good at saying, hey, in the last 100 examples, that's been a bad thing, versus the thing with a 20% free cash flow yield and 10% debt to assets, right? You should prefer one versus the other. And computers are really good at that type of question. But then when you say, hey, should I buy this particular company? I think it's helpful to apply a level of qualitative judgment and say, hey, that CEO's in jail. That company just got under investigation by the SEC for fraud. I know the computer likes them, but I'm a rational person. I don't know that that's a really good idea. And we believe in applying that level of common sense or human judgment to make sure that the model is doing what we set it out to do.
So you started your strategy in the U.S., correct?
We did. Yep.
Okay, and then you ventured out to different markets. Can you maybe tell us about that and where you ended up going?
Yeah, so we went first to Japan. The attractiveness of Japan is a fewfold, really three things. One is in terms of the number of listings, it's the biggest market outside of the U.S. So there are about 3,000 publicly listed equities in Japan. Second, it's very cheap. So one of the cheapest developed markets in the world. And then third, Japan is unique. It has had zero interest rate policy for decades. One element of that zero interest rate policy is basically a extreme aversion to allowing public companies to go bankrupt, which makes sense in the context of 0% interest rates, right? Why do you make a company go bankrupt if interest rates are zero, right? Like it doesn't really matter. They should be able to, roll over debt or refi or whatever. And so for investors in levered small value stocks, right? It's a really cheap market with a lot of small caps where you can't go bankrupt, so you don't get zeros. And the leverage is maybe not always a positive, but it's never a negative that causes bankruptcy. It's sort of an ideal market for us. And then next we went to Europe, which is much more similar to North America, about the same size as the U.S. or Japan. And Europe is also, noticeably cheaper than the U.S. And it's interesting because there are a lot of different, regional variations. Italy trades somewhat differently than the UK, which trades differently than Germany. And if you're diversified across countries within Europe, you can get a really interesting return exposure. So those are our three geographies in which we operate today.
Let's jump to some of the research articles that you've written in the past, which by the way, are very, very well written and funny and very compelling to read. So I'm an avid reader of your papers.
Thanks.
First of all, how do you find time to actually write them? Because you have to run a fund.
I started my first job actually in high school was in journalism. So I think I spent 4 summers working at newspapers, just churning out content. So I have a lot of experience as a writer, and I actually write very fast. So it sort of comes easily to me to write. And then we are essentially a research shop, right? We're constantly doing research on what drives returns in equities and what's bad in equities and what asset classes should we look at or not look at. And so I think we just say, hey, why don't we take the research we're already doing and share it with people? And since it's relatively fast for me to write, that's sort of a great driver for our business.
And just follow up to that is, of course, you're not getting paid to write articles. You're getting paid to achieve returns for your investors and your funds. How do you make sure that the quality of your articles and the quality of your research is at par with, the best research in universities? How do you make sure that you're not lagging in any way in your research methodology?
I think the only way is to read very widely. I think you have to sort of stay up to date on what the best academics are publishing. And a lot of the time, sort of the simplest topics for us to write about are just updating people on what the latest academic research is, because a lot of people don't have time to read it. And since we're reading it anyway, sometimes just summarizing what other really smart people are writing about is a big source of our content. And then I think, second, we're quant investors, and I think there's nothing more rigorous than being a quantitative investor, because not only are you doing your research, but you're betting on it every day. And so there's a level of rigor you apply because, if you're wrong, you're going to lose money, not just get dinged by reviewers in a paper. So I would say that there's a bar of sort of practicality and reality to the work we do, because we're not only writing and writing about research and doing research, but we're actually implementing that research on a day-to-day basis in the real world. And so I think that we actually have a claim to be, better than the academics who are sitting in the ivory tower who don't even touch the things that they are writing about.
Interesting. So one article or a series of articles that you've written are titled, appropriately so, Size Matters. And can you maybe talk about them?
Yeah, absolutely. So our view is that when it comes to quantitative investing, every quantitative strategy is at heart a ranking system, right? So let's say you have a value strategy, right? You're going to rank every stock on your preferred value metric. Let's say it's EV to EBITDA or something. And you're going to say, well, gee, what I found by doing a regression is that value works. And so that means that the cheapest things on EV to EBITDA are much more attractive than the most expensive things on EV to EBITDA. And so what's interesting then is that if you take, say, the U.S. equity market, let's say it's 3,000 equities, it's a little more than that, but let's say roughly 3,000, and you divide it into deciles by EV to EBITDA, for example, I would say one thing you're going to find is that over long periods of time, the cheapest decile outperforms the next cheapest decile, outperforms the next cheapest decile, outperforms the next cheapest decile. And within that cheapest decile, the cheapest 30 stocks outperform the next 30 stocks, outperform the next 30 stocks. So there is a very linear relationship between a good factor and returns. Now, what's so far so good, right? So I think we're not breaking any new ground there. But what's interesting when it comes to market structure is that there are a lot more small stocks than large stocks. So let's say of those 3,000, 500 are large caps that are in the S&P 500, and 2,500 are, just for simplicity's sake, small caps, 2,000 of which are in the Russell 2000 or whatever. And if you look at the extremes, like the cheapest decile, is almost entirely composed of smaller microcap stocks, such that the cheapest decile in the U.S. market has an average market cap of less than $200 million. And so if you say, hey, I just want to own the cheapest 300 stocks in the US because I'm a believer in value, and the average market cap of those is 200 million, and you do some quick math around that, you'll probably get to saying, hey, I can probably put a maximum of 5 million in any individual stock. And so if I want to put 5 million in equal weight, there's 300, I'm probably maxing out at 1.5 billion of capacity. And then if you say, well, gee, I don't want to own 300 stocks because some of those, as we just discussed, are really low quality things that are going to go bankrupt. I only want to own, the best 100 of them. Then all of a sudden your capacity is 500 million. Mm-hmm. And our view is that if you look empirically, returns to quantitative strategies start to degrade the minute you either increase the number of holdings or increase the minimum market cap or daily trading volume of the stocks you're investing in, such that the performance and ability to generate alpha of almost any good quantitative strategy is very, very closely related to the capacity of that strategy. So if you're willing to run a $100 million fund or a $50 million fund or a $200 million fund, you're going to be able to generate a lot more alpha than if you want to manage a $15 billion fund. And what you've seen is that a lot of, especially in value, the index funds like the DFA or Vanguard runs are managing 15 billion or 30 billion, right? And there's simply no way with that amount of capacity that you can even pretend to be capturing the value factor in any meaningful way. So our view is that we are believers in running really capacity constrained, high octane strategies.
So you basically, for the rest of your life, you have it in writing and in many recordings that you will never run a fund that is, say, larger than $200 to $300 million.
Yep.
So I mean, from what I hear from that is you're not really driven by how much money you can make, which I assume a lot of hedge fund managers are. So what is it that really drives you to put out a statement like that might be detrimental for you personally in the long run?
So I believe in excellence, right? I mean, I have a simple goal. I want to generate as much alpha as I humanly can, right? And unfortunately, generating a ton of alpha and achieving excellence in asset management is made extremely difficult by managing large amounts of money to nearly impossible. So I think that if you want to be a good active manager, you have to be capacity constrained, right? If your goal is to generate alpha or to be excellent, that's a choice you have to make. It's table stakes in my view. And I think, it's a matter of what you really care about. And maybe I'm an idealistic, 32-year-old or whatever, right? Which I am idealistic and I am 32 years old. So I guess I meet both of those criteria. And maybe by the time I'm 50, I'll be, returning to your podcast to plug my new $10 billion long-term private equity fund. But I hope that I don't become so jaded.
Yeah, I will make sure to keep that in mind. I'll call you in 18 years. So what do you say to large institutional investors like the endowments of the world that, they have substantial amounts of capital that they would like to deploy, and, a lot of them have venture capital and private equity as a core part of their asset allocation. And then you come to them and say, hey, this worked in the past, but is not going to work in the future. Come invest with me. But hey, my fund is 200 million and your ticket size is probably larger than that. So what do you tell them?
I guess we're prophets of doom and gloom in that sense. I mean, I think we'd say, look, if you're trying to deploy very large amounts of money, I would say the chances are that index funds are going to be a better solution for you. And so, trying to do active management at scale is going to be quite difficult because the opportunities to generate very large amounts of alpha are very niche and limited. And so, probably the answer for a very large asset manager is that a smaller percentage of your assets should be active. Unfortunately, I wish it were not the case. But, I think you see, if you look at sort of the last 30 years for endowments, for example, endowments went from being essentially 50% equities and 50% bonds to being 50%, equities, 25% bonds and 25% alternatives. And one of the big explanations for why that is the drop in rates over that period of time. So if you were buying, say, BBB corporates and you had a 7% target return, in the 90s you could do that. And so it made sense to have a big fixed income allocation. But you fast forward to today when, say, BBBs are yielding 4 or 5. you're just not, as an institution, you can't do the math and say that should be a big allocation if 7% is your return target. And so instead they said, well, why don't we look at alternatives where the yield is less obvious or seems much higher, or the track record of the asset class is much smaller. And so we can sort of believe that these will provide higher returns that allow us to hit our 7%. But I think it's unfortunately that idea has become quite crowded. And that's why you're seeing, I think, maybe not a bubble, but way too much capital chasing niche, alternative, private, illiquid strategies because so much money has been forced out of bonds by these return targets. And I think it's really a scary world, because I think a lot of people are going to end up being really, really disappointed when they find out what their private equity partnerships from the 2018 and 17 vintages end up turning out to be from a return perspective.
Okay, interesting. So do you think your strategy would work in an interest rate environment that is not as low as, let's say it's a 10% interest rate environment right now? Do you think that would have a significant impact on how you run your funds?
Yeah, so we actually looked at the relationship between interest rates and changes in interest rates and small value stock performance, and then leveraged small value stock performance. And what we found very broadly is there's no relationship, absolutely none. No relationship to absolute level rates, no change in rates. And that is because rates are correlated very strongly with economic growth and inflation. So the higher economic growth and inflation are generally the higher rates, and the opposite is true. And so you can think about those as the numerator and the denominator in the discounted cash flow model, right? If you're in a time of high growth and high inflation, then the numerator in the DCF model is very large. Well, interest rates are likely to be high, so the denominator is going to be very large as well. Whereas times like today, when expected growth is lower and expected inflation is zero, and interest rates are very low, you end up with the same answer from an equity return premium. It's just because those things are also so correlated. Now, what I think does matter a lot is the high yield spread. So the high yield spread is one of the best economic indicators for making investment decisions out there. Ben Bernanke spent years writing about the importance of the high yield spread and thinking about high yield markets. But if you think about the spread as measuring the amount of liquidity available to small and risky companies, which again comprise the majority of companies by number, it's a wonderful indicator, because at times when there's panic and people stop lending, it's going to slow economic activity and people are going to panic in those small niches of the market, small companies. And so I would say that our strategy, while not sensitive to interest rates or, the Fed fund rates, is very sensitive to the high yield spread over those Fed funds rates.
Interesting. So you mentioned earlier that you were even more bearish on venture capital. Can you elaborate on that?
Yeah, so I think if you look at sort of the research from Ken French or Eugene Fama, the best performing segment of the public equity market is small cap value, and the worst performing is small cap growth. So if you pay a lot because you have very high expectations for a small company, one of the risks that you're not sort of understanding is both that you're likely to be disappointed on the growth prospects because very few things grow at very high rates for very long periods of time. And second, small companies are very fragile and go bankrupt at a much higher rate than large companies. So if you're going to buy small companies, you want to buy the ones with that are already profitable and generating cash flow. And that's going to make sure that your bankruptcy rates aren't too high. And if you buy them at a good valuation, you're going to get a nice return. And that sort of seems to be what the evidence suggests. But if you buy sort of hope and prayer and dreams companies and very high multiples that are not yet profitable, you're going to end up with a ton of zeros. And if you look broadly at the history of venture capital, with the exception of the late 90s, venture capital has systematically and dramatically underperformed the NASDAQ and the S&P 500 and the Russell 2000. And it's totally and eminently logical why it should underperform, because just like private equity used to be at least small value on steroids, venture is small growth on steroids. It's like micro cap extreme growth. And it should be no surprise that it's not a particularly profitable investment strategy.
But you're talking in general terms, right? Or are you talking about, because there are some venture capital firms that have been able to consistently generate strong returns in the past. Are you talking about the median returns of the asset class, or?
Returns, you could even look at like the 75th percentile returns. They're all horrible. There is a subsegment of firms that have repeatedly made money. I think you're absolutely right about that. The Excels and Sequoia and Andreessen Horowitz's of the world who seem to have been able to consistently at least buy winning lottery tickets. But I think outside of that very, very small segment of funds, the returns for the vast majority of investors in venture, and remember, even the people that have, investments in Excel or Sequoia likely have investments in 10 other venture funds, and so they're not just getting exposure to the best. It's fortunately been fairly brutal, and I sort of, heard it said that venture capital is the rich man's lottery ticket, and I think there's some truth to that.
That's interesting. This is something I think a lot about. We look at private equity and venture capital in the developed world, specifically in the U.S. It looks like there are not that many low-hanging fruit anymore, meaning it's very hard to find companies that you can, if you buy the argument that you can come in and change operationally and create a profit from that without considering multiple entry multiple and exit multiple. But then if you look at emerging markets where markets are not as developed and there are not a lot of Harvard MBAs trying to buy companies, do you think that just the fact that there are more low-hanging fruit outside of the developed world, do you think that private equity and venture capital could work in those places?
Yeah, I think that I separate out venture, which I'm sort of bearish on universally because I don't like paying high prices for things because I think they're going to grow a lot, right? I just don't think that's a great model generally. Private equity, I think, is just valuation dependent. So I think if you find markets where you can buy things consistently at 5 or 6 times EBITDA and lever them up 60%, I think those are going to be great markets for private equity. I mean, the history would suggest that they'd be great markets. And so I think if you said Japan, for example, the deals that private equity firms are doing in Japan, I find them almost all to be attractive because they're done at these very low valuations, very little risk of bankruptcy, very low interest rate debt, great free cash flow yields. So I think that that, for example, is a wonderful place to invest in private equity. But I think it's all, for me, driven by the valuation environment.
Yeah. Okay. So the last piece that I would like to touch on was one very interesting, and they're called "Do MBAs Make Better CEOs?" and "Is CEO Performance Persistent?" Can you maybe talk about those two?
There was a Harvard Business School professor, Arthur Jensen, who made the argument in the late 80s that one of the big problems facing America was that not enough Harvard Business School graduates were going into corporate management careers. And his view about why this was the case was that the pay was uncompetitive relative to, say, finance. And so his view was that you want to align incentives. I mean, that's almost become a sort of cliche or a sort of a everyday common phrase, but it didn't always used to be. You wanted to align incentives for corporate management. So you wanted to basically say, we're going to pay you not just a salary of $1 million a year, $2 million a year, but we're going to pay you incentive-based comp that's tied to stock price performance because, again, we believe that the point of a company is to generate value for shareholders. Therefore, why not tie your pay to the most clear thing that you should be incentivized on, which is the share price or the value to shareholders? And that all sounded really, really good in theory. But there are a few problems with it. The first is that the premise that you want to pay higher prices to attract better people, there have to be some identifiable characteristics of those better people, right? And I'd say, there are a few of them, right? You'd say, well, the best people went to Harvard Business School or Stanford Business School. Or you could say, well, the best people had really good track records. So they ran another company and did really well. And I think if you look, as we did a massive study where we paired the CEO database with the stock price performance database. And what we found is that having an MBA or a top MBA has no relationship to future stock price performance. In fact, neither does historical performance. So if you've been a great CEO for 3 years, doesn't have any prediction about how the stock price is going to perform over the next 3 years that you're the CEO. And so our view, and actually, if you look at executive compensation, there's no evidence that higher paid CEOs produce better shareholder returns. So in essence, the public equity markets and corporate boards have been seduced by this idea that they need to pay up to get top talent on their CEO and corporate management teams. And it's flawed logic because there's no objective definition of talent which seems in any way correlated with stock price performance. And compensation itself, just the alignment of incentives, there's no evidence that aligning incentives or paying people on stock-based comp generates higher returns. So it's all basically completely wrong. It worked in theory, but not in practice. And so I think the down arrow, or the conclusion from my perspective of this research, is that, executive pay has gotten way out of whack, and we should just go back to paying them $2 million a year and cut all the stock-based comp, because it doesn't drive better outcomes. It's just a transfer of cash from shareholders to corporate management teams for no meaningful benefit to shareholders.
Why is no one else doing this type of research, Dan? Because this is something that, at least in theory, makes a lot of sense. You look for the Harvard grads and you pay them more so that they can achieve higher returns. And then you mentioned, I guess, one thing that a lot of people in the market believe, and I believed until I read your paper, that higher interest rate environments are worse for equity returns, and you went ahead and researched that. So why isn't anyone else looking at these things?
Yeah, well, I think Howard Marks said, to be a good investor, you have to have a different opinion than the consensus, and you have to be right. And I think our view is that as we think about what to research or what to write about, we look for places where there's a mismatch between common sense or public belief or the consensus and then what the empirical data suggests. And that's really if there's one sort of a driving through line that connects our research and our investment strategy, it's saying, where are there places where we believe the vast majority of people really agree strongly and where they're empirically wrong. And I think the topics we've discussed, interest rates and equity returns, CEO pay or CEO quality and equity returns, a lot of these questions have that characteristic in common. And I think what they often have in common is a really good story that makes a lot of intuitive sense. Okay, Harvard MBAs should be better at running companies and we should pay them more because of that. And it makes a lot of sense. It's just not true empirically. And I think the same is true of interest rates. The intuition behind it is very simple and logical. Higher interest rates to result in worse stock price performance, but the reality is it just isn't true. And so I think that's what drives our research and what drives our investment strategy as well.
Interesting. And whenever we're looking at, I guess from our perspective of the world, whenever we're looking at a pitch deck from a fund, and we see that they went to the best schools and cut their teeth in the best companies, such as yourself, you went to Harvard yourself. It sort of gives. It's not like we're going to make a decision based on that, but it ticks a box. So I'd be curious to hear what you think the findings would be if we were to look at hedge fund performance based on where hedge funds went to school. Do you think you would find equally surprising results?
I think we'd find that people that went to Harvard undergrad and got Stanford MBAs and worked at Bain Capital are really the peak. No, I don't know. I don't want to make the case against my own credentials.
Yeah. I don't know if you have any tips on how to perform that research if we were to ever do that, because I think
it'd be way too complicated to do. I think people should just stay away from it.
Okay.
Lest we find something that would be prejudicial to my self-interest.
I see what you're doing there. Dan, just lastly, as we like to do in the podcast, as we interview high-profile people and with Harvard undergrads such as yourself, so can you maybe, if there is a younger listener there that is still not quite sure what they want to do in finance, do you have any tips or tricks that helped you along the way that you think could be beneficial to them?
If there's one thing that's served me well, it's exposing yourself to as much research and thinking from other people as possible, because I think experience is always limited, but libraries are unlimited and almost. And so I think that I've learned so much from using Google Scholar and from reading some of the books by the great investment thinkers. And, you think that Howard Marks or Ray Dalio or David Swensen, some of the great minds of finance, have put down all their thoughts on paper and published them in books. And you can go read them and basically get fully up to speed on their investment approaches. I think is an unbelievable opportunity. And so I'd say, that more than anything else would be the key to, at least when I look back and say, what have I gained the most from? It's just reading more than other people and having being able to build off other people's good ideas, because the chances you're going to come up with a new idea are low. But if you could take a good idea that isn't being implemented now or isn't perfectly being executed, or you could combine, good ideas from multiple places, it's a much easier path.
I guess a lot of people think that they don't have the time to read. So I'm assuming that you set aside time to read every day, or is this not something that you do?
I do, yeah. I probably read, I don't know how much I read a day, but a lot, probably at least an hour or so a day.
Well, very good. Dan, well, thank you very much. Again, I want to acknowledge you for the very high quality and entertaining research, and thank you for actually making it available to the wider public. And I would encourage anyone who's listening, who is interested and curious about finance, to check out your articles. At least they will make you think, if anything. And lastly, where could people find out more about what you're up to?
So, I think my weekly research would be the best place. And Twitter, I'm at Verdad Cap is my Twitter handle. So those are probably the two best places.
Perfect. Dan, thank you again. Thank you very much.
My pleasure. Thanks for having me on.
Thank you for listening to the Wall Street Lab podcast. For the show notes and much more, visit us at www.thewallstreetlab.com. To see what we're up to before anyone else, subscribe to our newsletter on our website and follow us on Facebook and Twitter.
Disclaimer. Information contained in this podcast constitutes the opinions of individuals and should not be treated as investment, tax, financial, or legal advice. We take no responsibility for the accuracy of any statements made in this podcast. This podcast is for informational and educational purposes only, and it does not contain an offer to sell or buy any sort of financial products and should not be treated as advertisement for such. Any copying, distribution, or reproduction of this podcast without the prior permission of the creators of the podcast is strictly prohibited.